Professor Carl, I want to know why different alternatives of investment have different return. Is there any basis of this?
Let me explain you in simple word. First, you answer my simple question. If I offer you two alternative, both gives you return of 7% and one is risky whereas other one is not risky, which one you will choose?
Obviously, if similar return is there, I will accept the offer which gives me same return at less risk.
Great! Now let me change the situation. If I offer you now 7% with no risk and 15% with slight risk, what will be your answer now?
Professor Carl, I would like to take more risk and get double return in this situation.
Good, Kate. Your obvious answer to my questions have its root in theory which is known as capital asset pricing model, also known as CAPM theory.
Seems interesting. Can you please explain this CAPM theory?
Let me explain in simple words. A theory describes the relationship between risk and expected return, and that is used in the pricing of risky securities. The formula for CAPM theory is risk-free rate of return plus beta multiplied expected return minus risk-free rate of return. The general idea behind CAPM is that investors need to be compensated in two ways: time value of money and risk. The time value of money is represented by the risk-free (RF) rate in the formula and compensates the investors for placing money in any investment over a period of time. The other half of the formula represents risk and calculates the amount of compensation the investor needs for taking on additional risk. This is calculated by taking a risk measure, beta, that compares the returns of the asset to the market over a period of time and to the market premium, RMRF.
Great, Professor, what a theory. Today I realized why some alternative are getting the premium return as they are having greater risk. Can you also explain this theoretical model by calculation?
Let's take example like if the risk-free rate is 3%, the beta of the stock is 2, and the expected market return over the period is 10% as per CAPM theory. How much return you should get?
As per the formula, it should be 17% return.
Correct, Kate. This means that on the basis of this theory, at this risk-free rate in the economy and your expected return for the risk you are taking, if you are not getting 17% from this alternative, you should not invest at all in this. In conclusion, we can say, Kate, that the capital asset pricing model is by no means a perfect theory. But the spirit of CAPM is correct. It provides a usable measure of risk that helps investors determine what return they deserve for putting their money at risk.
Applause for your explanation and a theory, Professor Carl. Today I have understood why fixed deposit have different return and stock market is expected to give different return.